The question we had from email came in from Anthony. And Anthony asked 3 questions. I'm going to go through the 3 questions first, and then we're going to talk about my initial replies, and then we're going to go to Power Options and look at some of these adjustments or concepts as they appear on the profit and loss chart or in other tools. Anthony says, if you have a collar trade on a position and the stock suddenly begins to rally like a week ago, can you mitigate the position to prevent assignment? Collar, of course, is buying the stock, selling an at or just out of the money call, and buying an out of the money put for a lower price. You have a controlled risk in place with a potential to earn an assigned profit, similar to a covered call trade. Anthony said, I was thinking adding positions to make a put credit spread and a bear call credit spread, essentially adding an iron condor to the collar. And then he said, when you put the trade on to begin with, would it be a good idea to put stops on the trade to prevent it getting called away? Well, my initial response is by email related to question 1. Can you mitigate the position to prevent assignment? Well, if you want to stay in the collar position, you have to roll up the short call. It's an obligation to deliver shares of stock, and if it remains in the money, even if you potentially do other things around it, you still have that obligation to deliver your shares of stock, thus ending the collar trade. But you may also be able to adjust the put to a higher strike as well to mitigate the downside risk potentially as you're going to a higher strike price, but that depends if you have to roll the call for a debit or a credit and what price you could get for the new put strike price. Adding positions to make a put credit spread and a bear call spread, well, that would be an iron condor, comparing the two out of the money vertical spreads together. Doing that to a collar position or just doing a bull put or bear call would bring in a small amount of premium to help maybe mitigate the risk of rolling or buying back the short call that might result in assignment for the stock position in the collar. But it won't cancel the obligation of that short call obligation. You still have to look at buying or adjusting the call. Now, if the stock starts to ramp up quickly, you may be able to just buy a higher strike call on the collar, which would leave the upside open, but you would have an additional cost into the position. Is it a good idea to set alerts? Yeah, many investors will use stops or contingent orders or alerts if the stock approaches the sold call strike or the sold call goes in the money, whether it's an out of the money covered call where they want to keep the stock long term or a standard collar position that they want to keep continuing for several months in a row. Now, just to stop on the call would likely just buy to close the call at market price, but it wouldn't do a roll for you. A contingent order, of course, is going to close the whole position in most cases at a broker. If you set a contingent to close all, if your alert is triggered on the short call strike price, you buy to close this call, sell to close the stock, and sell to close the put. Then you'd have to re-enter the collar again anyway. But alerts are a good thing to use. I typically set the alerts in the Power Options portfolio. And when an alert's triggered, then I'll go in, use the tools to evaluate my rollout opportunities. Speaking of which, let's go ahead and navigate over now to the Power Options suite of tools. And we're going to go through this example. It's these ideas that Anthony brought to us using the tools and some other things. Now, for those of you that are currently on a trial or your subscription to Power Options, your subscriber to Power Options, we just again launched the recent survey there. It's just a quick 2-question survey. Would you recommend us to any trading friends or colleagues or anything like that? And what type of improvements or ideas would you like to see on Power Options? So it just takes a couple minutes. The feedback helps us generate new ideas, generate new tools, improve ourselves for better performance for you and a better experience for you as well. So take the time to answer the survey for us, and we'll be sure to get back to you related to your comments and ideas. Okay, so we're going to head on over to Power Options right now. And I put a collar trade into the portfolio tools, and we used Annette, current position that I'm in as a married put over at the Fusion portfolio, radioactive trading, a married put, not a standard collar. But let's go ahead and take a look at the profit and loss chart here and analyze what this is. Now, back on the 17th, just a few days ago, on Monday, we could have bought shares at Annette around 104.50. So 100 shares would have cost us $10,450. Maybe sold a slightly out of the money 106 call for $195, October 28th expiration. It's about 2 weeks out, 11 days out in time. So it's like an out of the money covered call, but we're going to take some of that premium, and buy an out-of-the-money 100 strike put for 85 cents. So we're still generating about $1.10 of income for this transaction. Between the call and the put premium, we're generating 110, so our cost basis total drops down to 103.40 per share, or $10,340 for 100 share position. Now, if the stock moves up, goes above 106, which it has, and we get assigned, we'll make a 2.5% return on the upside. And if the stock falls, goes opposite what we originally expected in our direction, and drops below 100, where it was a few weeks ago, or not a few weeks ago, but about a week and a half ago, then the put guarantees us an exit where we can't lose more than $340 total, or 3.3%. This is a really good risk-reward ratio that I like to use for my standard collar position. Same expiration, at or just out of the money call, out of the money put for a cheaper price, looking to make around 2 to 2.5% return max, while risking between 3 and 4% as a maximum risk if the stock gets away from us and declines drastically in price. But where are we now? Now, ANET has gone up to 110. It's above our short call strike price, which, just like a covered call, means on this collar, we're going to be obligated to deliver 100 shares of stock. We could sell to close the put, but it's probably only worth 5 or 10 cents at this time. How can we mitigate or prevent assignment? Well, when I have a position, covered call, naked put, credit spread, married put, and I'm tracking it in the portfolio, the first thing I want to do when my alert is triggered, I would have set an alert here to be notified if the stock went above 106.50, just above the short call strike price. We'll use that more information button to go to position actions and then position analysis. This will give us a breakdown of our current position. As we scroll down further, of course, we can see our current liquidation profit. If we closed everything out right now a week early, we'd make 1.7%. It's less, of course, due to the time value you'd have to pay to buy to close the call. We're not taking true assignment for the maximum return at expiration of 2.5% if, of course, the stock remains above 106 on October 28th expiration. We know that we collected the $1.95 just for the call, but it shows us here it's going to cost us $5.75 to buy it back. So we're going to lose about $3.80 when we close this call position. But down below, it shows us the potential rollout opportunities for the short call, the new max percent if assigned if we're assigned at the new position, and the new call midpoint we could receive. We could go out 1 week to November 4th to the 112 call for $5.45. That would cover our debit of $3.80. And if we got assigned at 112, we'd increase it to 8%. Of course, going further down, we can see that we can still go out of the money here up to about the 116 strike or 115 strike and still cover that initial debit from the 195 we collected minus the $5.75 buyback cost on the position. Not a high credit, keep in mind. This would only be about a 40-cent net credit, but it does increase the percentage return to 9.6%. But this is just the call. It's not really showing us the put. If we take a look here, it's great to see things numerically. We can also see things graphically. So let's go to Simulate Trade. And this will give us a side-by-side comparison of where we are right now, current return of 1.7% with a max return of 2.5%. But just rolling the call gives us this weird sort of checkmark profit and loss chart. And why is that? Because we're not looking at moving the put. The put's till 28th of October, and the call now is further out in time to November 4th. However, if we get assigned now at the higher strike at 115, and we were able to roll for the credit on this position, small credit again, mind you, well, we'd end up with that return of 996. But note that the risk increased as well from 3.3 to 4.8. And don't get me wrong, this is a great risk-reward ratio, 9.5% return. But what's going to happen at October 28th expiration? The 100 put is going to expire worthless, and we're going to have to look to buy a November 4th put if we don't roll the put now. So that's going to take away from this upside net credit due to the new cost, but it may actually mitigate some of the maximum risk in that case, or it's probably going to slightly increase it, I should say, as well. But we still might end up with that good ratio we want to see for the standard collar position. Now, Anthony's question, second part, was adding positions to make a put credit spread and a bear call credit spread against this position to sort of potentially mitigate the losses. Well, let's go back to the profit and loss chart here. And what are we talking about? Well, I might be considering rolling up this 106 call that is now in the money, which obligates me to deliver shares of stock, and thus we will be out of the collar trade altogether. To continue the trade, what if we did add an iron condor? Well, let's start. Let's just do the bull put side first. So our stock's at 110. We want to stay out of the money slightly, but we still want some premium. So let's go ahead and, let's do the 5-point. Let's do the sell the 105 and buy another 100. We're going to get about 90 to 95 cents. And of course, then we're going to pay back about 40 cents. It looks like 42 cents. So yeah, we're going to get about 40 or 50 cents. Maybe we could go a little bit higher, but let's stay with that range. So adding the bull put by itself, what is that going to do to our initial position? Well, it increases the profit up to 2.9%. It increases the risk to 7.3%. Now I'm sort of out of bounds of where I want it to be for that risk-reward ratio, keeping it close to 2 to 1 or 1.5 to 1 there as far as risk to reward goes. We've almost doubled it now, which is close, but it's a little bit more. It's about 2.5 to 1. We also take on an extra monetary requirement because we have to cover the obligation of the bull put. So risk increases, return goes up slightly. Risk almost more than doubled. Risk goes up, return goes up slightly. And we still have an obligation to deliver shares of stock. And we'd be out of the collar position with a successful bull put credit spread, provided the stock stays above 105, 106. Now let's add the other leg, the bear call credit spread. Very, very similar structure, just on the opposite end. Let's do about the same thing. We'll do a 115, 120. We'll get about the same premium of around that 50 cents or so. And okay, so now what have we done? We've increased the profit up to 3.5% from where we started at 2.5. The risk comes down again because we get that new premium to the downside, so it only goes up to 6.4%. So we gained 1% on the return potential to the upside, and we've increased the risk by about 2 times, from 3.3 to 6.4. We start to lose in 2 ways now if the stock moves up above 120. And what do we still have? Well, we've got this little iron condor, but we still have the obligation to deliver shares of stock at 106. This does not negate that obligation at all. We've got 4 separate legs and 2 new vertical spreads where if it goes this way, we lose on the collar and the bull put. And if it goes up this way, we'll lose on the bear call, but the collar and the bull put would be profitable. In fact, it would be max profitable for those 2 portions of the position. I don't like to confuse things like this. I don't like to take a strategy and confuse it by adding multiple legs, especially if it doesn't really cancel the obligation that I have to prevent assignment, which was Anthony's first part of the question. The one thing I might consider as the stock is ramping up, depending on what my future outlook is for the stock going forward. We only have 7 days left on this trade. And I might do this at the onset in a standard married put position, of course. You might know it as income method number 6 that you've heard us talk about before, but is in the blueprint. But now that the stock's starting to move up and is above my call strike price, what I might have done as the stock moved above 106 is buy the 108 call, which would have left the upside open. However, now that it's in the money, it's a little bit too pricey. It's going to increase my risk. So let's go a little bit out of the money here. All right, well, I'll go with the 115. That seems a bit far-fetched. But the stock did move from 104 to 110 in about a 5 or 6 day period. So in another 4 or 5 days, moving up to 115, if the trend continues, or maybe above it, is not too bad of an idea. So what does this do now? Oh, well, we take away the credit, so that means the risk's going to go up. Yeah, the risk goes up to 4.2%. And we have this plateau here where we still have a profit of around 160 or so at expiration. And if it really gaps up and takes off, goes up to 120, 125, 130, we leave the upside open on the potential trade. So it's doing a bear call spread, but after the fact. What I'd normally like to do in this situation, which isn't always possible when this is happening, is to hopefully pay less for this extra long call as the stock starts ramping up than I originally collected. Oh, I'm sorry. I'm looking at the wrong price. I apologize. But yeah, we got 195, so I am paying less. That's great. But now the total net credit in is only 10 cents. That's what's increasing the risk, of course, and the cost basis of the entire position, entire standard collar position. But that is another idea one might consider, is just instead of doing some elaborate spread inside of it, which just gives you a small premium but doesn't cancel the obligation, maybe just adding that long call, not as a spread that's capped, so you still leave your upside open, hopefully at a cost lower than what you initially collected on the first call you sold. Now, the drawbacks of this, of course, is this doesn't really mitigate or prevent assignment either. I can still be assigned anytime on this short call position now that it's in the money. And I'd lose the stock position. I'd be left with a long put and a long call. We'd kind of be in an out of the money long strangle at that point for the next 5 or 6 days. But what it does do is if the stock rockets up this way and continues up to 120 or 122, starts exceeding expectations, then this long call can cover the short call obligation potentially. And why do I say potentially? Your broker may still link these two together to assign the stock, but that's okay. Now the stock's up at 125. You have the right to buy more shares of stock at 115. You've taken the profit here on the covered call portion. You add to the cost of the stock right now to go up to 115, but the stock's trading at 120. So you still have a pocketed unrealized gain in those scenarios. Well, you've got the pocketed gain, on this portion, even if you're assigned on the stock from 104 to 106 and the 195 premium minus the 85 put strike. You can buy back stock at 115 and start the collar over, rebracket the entire position. Now, in relation to Anthony's question, the first and foremost related to standard collars, let's just go back to our standard collar format. You've always heard me say this. When I enter a standard collar, it's usually under 30 days out in time. I'm looking at a straightforward approach of sort of mimicking a covered call trade at or just out of the money, but with guaranteed protection in place with the put option. This to me is sort of a fire and forget position, meaning I only manage it 3 ways. Am I right? Am I the best collar trader in the world? Absolutely not. But I opened the shorter term collar with the hope of just one, getting assigned on the position because the stock moved above my short call strike price. I get the max return on the position and I had the risk reward ratio that I want, and I'm all set. Number 2, I guessed wrong on the stock. I guessed wrong on the market conditions. The Fed surprises us with some other comments about how they're actually going to increase rates by 1.5% next cycle, and everything just plummets and the stock goes down to 98, 95, $90 per share. Okay, well, I've hit my max loss on the position. I'm just going to simply allow my put to be exercised. The call expires worthless. I'm out of the stock and I take a loss of just 3.3% on the total transaction. I'll either look for new collars on the next cycle that match my underlyings, that match my sentiment for this strategy, or look to do other positions if my entire sentiment in the market has changed. Number 3, if the stock ends up in this area here, kind of anywhere in here where the loss is not too big, the gain is not too big. Hey, maybe if I have a gain of 1%, 1.5%, I'll let the call expire. I'll just liquidate the whole position, take my 1%, and then look for a new trade. But most likely here, the call expires worthless, the put expires worthless, and I'll look to rebracket the collar for the next cycle out, whether that's 1 week out, whether that's 2 weeks out, or whatever. And just continue the collar in that way. But normally if it does what I want, I'll allow it to be assigned because I've hit my targets for this strategy and my trading plan in the portfolio. If it falls, rather than try to keep rolling and adjusting, I'll admit that I was wrong in the direction of the stock at that time or the sentiment of the market. I've limited my loss to only 3.3%. I might just take that and move on rather than try to continue rolling and adjusting this position in a market that's not doing what I expected, or specifically on a stock that's not doing what I'm expecting for the strategy I applied to it. Number 3, of course, rebracket if it ends up in between. Rebracket the entire position. Sell a new call, sell a new put on this in this case, and continue it for the next cycle out in time. Another approach that could be used, okay? So that's what I look for in the collars. And yes, Anthony's final point, when you put the trade on, would it be a good idea to put stops on the trade to prevent it getting called away? Putting a stop on it won't prevent it being called away. If I put a stop that I want it to be a stop at 106.50 when it goes slightly in the money, you could put a stop on just the call, and your broker might buy to close the call, so you'd avoid assignment, and you'd still have the married put position open for a little bit extra. 8 days, 5 days, whatever it is when you close it. If it's a contingent order that you set, then they might close everything in those cases. You'd buy to close the call, sell to close the stock, and sell to close the put. What I typically do in the portfolio is I would set an alert. If the stock reached up 106.50, my call was now in the money, then what I would do potentially is, well, what I would do in that case when my alert's triggered, I'd go to the PowerOptions portfolio, as we showed before. I'd use that Edit More Information button to go to Position Actions, and then Position Analysis, and view and evaluate the rollout opportunities that come up to see which call I might want to roll to and how that might affect the position, and which put I might choose as well. Okay, so that's how I approach a standard collar position for me. It's just a, shorter term. I don't want to say, let me just add that. I'm sorry, folks. Thought I always had it in here, but I guess I don't. So let's just put in long collar. Yeah, there we go. So to me, the long collar is more of a shorter term, 15, 20, 30-day trade. I don't want to use the term fire and forget because there's really not something that's a fire and forget position in all aspects, but it's shorter term. And in this case, I'm just looking to get assigned to make the max return on the position with a controlled risk in place. Now, if I want to trade a position, Anthony, you know that I'm longer term bullish on, I want to hold for longer in my portfolio. Well, I'm going to open it as a married put following the rules in the blueprint and radioactive trading, which means I'm buying a put that's 5 or 6 months out in time or more and looking to control risk to single digits. And then what I'll do is use shorter term trades, selling nearer term collars, income method number 1 against the married put structure to lower the initial at risk, generate income, and potentially increase the return on the trade.